Welcome back to Reg Talk UK, the deep dive that helps UK banking professionals stay sharp, stay informed, and stay ahead of regulation.
Welcome back.
I'm Alex.
And I'm Jamie.
Okay, today we're diving deep into the Bank of England's November 10th consultation on sterling-denominated systemic stablecoins. This isn't just a summary.
No, definitely not. We're doing a critical assessment here.
Exactly. We're looking at the evidence, the models, the implications, basically asking, is this sensible protection, or is the Bowie hamstringing Britain's digital finance future?
And it really boils down to, I think, one massive question the whole industry is grappling with right now. Is the bank genuinely protecting financial stability?
Or
are they just, building a huge wall around the traditional banks while the U.S. and Europe basically steam ahead in the stablecoin race? The source material we've seen, well, it makes a pretty strong case for that second view.
Right. Let's get straight into the bit that's caused the biggest uproar. Talking point one. The £20,000 cap, this proposed limit for individuals, 20K, and $10 million for businesses per systemic stablecoin, or SSC.
Yeah, and the bank is very clear. They frame these as transitional measures, supposedly to manage risk during early adoption, stop money just flooding out of bank deposits overnight.
Okay, managing risk. But whose risk, really? I mean, you have to ask. Who benefits most from capping individuals at £20,000? Is it the average person on the street?
Or is it the big high street banks who are, frankly, terrified of deposit flight once people have a fully stable, digital, regulated alternative?
Exactly.
To be fair, the bank has run the numbers on usability. Their analysis suggests that 20K limit would still let 94% of consumers hold balances equal to about 2.1 times their monthly household income.
So they argue it's fine for everyday spending.
They do. They say it's high enough for routine stuff.
That sounds okay on the surface, but hang on, what about the other 6%? What about slightly larger, but still perfectly normal transactions?
Like buying a new car.
Exactly. A new electric car costs, what, £30,000 on average now? Forget a house deposit average is over £68,000. You can't use this new regulated digital money for that. Why block the 6% who might want to make serious purchases or just hold larger sums securely in regulated digital cash, especially when it's fully backed?
And it looks even worse when you compare it internationally. Critics, and we're talking big industry players here like Coinbase, the Payments Association, they point out that rivals like the EU with MiCA or the US with things like the proposed Genius Act.
They're focusing on the issuer, right? Strong reserves, good governance.
Precisely. They're focused on making sure the stablecoin itself is safe. They're not putting arbitrary limits on how much an individual can hold or use.
So why is Britain always, it feels like, the slowest, the most restrictive major market? Is this just nanny state thinking disguised as being prudent?
Well, that cautious approach leads us straight to their main justification, which is talking point two. The stress test is science fiction. They need a reason for these caps, and the reason they give is mitigating the risk of a, quote, disorderly transition.
Okay, tell us about this stress scenario they modeled. How bad are we talking?
We're talking severe. They call it a severe illustrative stress event. And they explicitly say it's worse than the March 2023 banking wobbles, SVB, Credit Suisse.
Right. Those were management failures mostly, not systemic stablecoin runs.
Exactly. And the modeling is designed to show that without these caps, the disruption would be huge. They claim it could hit $250 billion in lending demand versus only $112 billion with the caps.
Okay, but the crucial bit, the bit that smells funny, is the assumptions they make about how people and money would behave in that stress. That's where it gets, well, controversial.
You've hit the nail on the head. The model assumes these incredibly high outflow rates from banks. Get this, around 10% for individual insured deposits.
Which is already double the standard requirement.
Double the LCR, yeah. The liquidity coverage ratio standard, but honestly, that's not even the headline number. The really wild one is the assumed outflow for individual uninsured deposits.
Okay, what is it?
75%.
75% of uninsured deposits just vanishing. That feels plucked from thin air.
It feels extreme, doesn't it?
Why would they base policy on a number like that? It doesn't feel like realistic stress testing. It feels like they worked backwards from the answer they wanted, needing caps, and cooked up a fantasy scenario to justify it.
The bank's defense is, look, the UK credit system is much more reliant on bank lending than, say, the US market. They argue they absolutely have to avoid a sudden crash in credit availability. So this severe modeling, they say, shows that without caps, the hit to UK credit markets would just be too big to handle.
I get the mandate to protect credit provision, I really do. But using these, frankly, exaggerated fear numbers, 75% deposit flight, to justify throttling British innovation, it feels much more like protecting legacy banks who maybe haven't sorted out their own funding models properly since the last crisis.
It certainly raises questions about the balance.
Okay, let's shift gears slightly because it wasn't all restrictive. Talking point 3, the one win backing assets. The bank did actually make a pretty big concession here, which is crucial for commercial viability.
Yes, this was definitely a win, and it came directly from industry pushing back hard.
Yeah.
Remember the initial idea back in 2023? 100% backing in unremunerated central bank deposits.
Which would have killed any business model stone dead, no return possible.
Exactly. Commercially impossible.
Yeah.
So they backed away from that.
So what's the new mix? How can issuers actually earn something?
Okay, so systemic issuers now need to hold a minimum of 40% of their backing assets in those non-interest-bearing BOE deposits. That's for immediate liquidity.
Right.
But they could hold up to 60% in short-term, sterling-denominated UK government bonds, gilts.
Ah, okay. So that 60% in gilts, that's where the return comes from. That makes sense, and it brings the UK more in line with what others are doing.
It does. And they added a couple of other supportive things, too. There's a step-up regime. So a brand new systemic issuer right from launch.
Yeah.
They can actually hold up to 95% in gilts initially to help them scale up quickly. Then they gradually bring it down to the standard 60%.
That's actually quite smart. Gives them a runway.
And they're also looking at potentially giving eligible firms access to a backstop lending facility.
Yeah.
So overall, pretty strong support for the business model itself.
But, and it's a big but, this just brings us right back to the first point, doesn't it? What is the actual point of creating this commercially sensible backing model?
If you then immediately slap a 20K cap on the retail side, crippling growth potential.
Exactly. It's like building a Formula One engine, but fitting a governor so it can't go faster than 30 miles an hour. They can earn a bit on the reserves, fine, but they can't achieve the scale needed to actually challenge the status quo or drive mass adoption. It feels contradictory.
It does feel like giving with one hand and taking away with the other.
Right. Now, just a quick reminder for everyone listening, if you're finding this deep dive useful, please do hit follow on Spotify or subscribe over on YouTube. It genuinely helps Reg Talk UK reach more compliance professionals like you. Please do.
Okay, so the commercial viability is there, sort of, but capped. But let's pivot again, because even if the BOE's rules were perfect, what good are they if a completely different regulator, HMRC, is sitting on what you call the silent killer? Let's get into talking point 4, the tax trap nuclear bomb.
Yeah, this is potentially huge and is not getting enough airtime. The ICAEW, that's the Institute of Chartered Accountants, flagged this way back in response to the previous paper, and crucially, it still hasn't been fixed.
And the problem is?
The problem is fundamental. HMRC currently treats crypto assets, and that includes fully regulated sterling-pegged stablecoins, as property or an asset, not as currency.
Okay, so practically, what does that mean if I want to use my regulated digital pound to, say, buy a coffee?
It means, technically speaking, every single time you do that, you're disposing of an asset, which could trigger a capital gains tax obligation and require tax reporting for UK residents.
Wait, hang on. Every single time. So tapping my phone to buy a latte becomes a disposal event I need to track for my tax return. Technically, yes. The administrative burden alone. Just think about tracking hundreds, maybe thousands of tiny transactions, even if the actual gain is zero or negligible.
It would be completely unworkable for everyday use. People just wouldn't bother.
Exactly. It's a massive hurdle. It really is the silent killer that could make the whole BOE framework, caps or no caps, pretty much pointless for actual consumer adoption.
Yeah.
And like you said, not enough people are talking about this specific tax angle.
Which leads us neatly into talking point 5, the competitive nightmare. You put the BOE's prudential limits together with this, frankly, archaic tax treatment.
And you have a recipe for the UK regulating itself into a corner while everyone else moves ahead.
It feels like it. We're seeing the US, the EU, Singapore. They're all focused on creating frameworks that are permissive, clear, scalable. They want this business.
Whereas the BOE's approach, with these transitional limits that might last for years, just creates uncertainty. It makes the UK look less attractive as the place you'd want to set up a major stablecoin operation.
It brings us back to that fundamental question, doesn't it? When did protecting the existing banking sector become apparently more important than fostering genuine innovation and keeping the UK competitive in global finance?
The bank says it's worried about disintermediation risk, banks losing deposits too quickly.
But maybe the biggest risk here is the one they're creating themselves. this self-inflicted competitive damage, becoming irrelevant.
It's a real danger.
Okay, final point. And this one, I think, really shines a light on the underlying motivation here. Talking point 6, the real agenda, the wholesale carve-out.
Ah, yes, the part they don't cap. The consultation document is explicit. Those controversial holding limits, the 20-pound K for people, 10-pound meters for businesses, they do not apply to stablecoins used for settlement within the Digital Securities Sandbox, the DSS.
And the DSS, just to remind people, that's the joint BLIFC project for live testing of tokenized securities, primarily used by banks and big financial institutions for wholesale market stuff, right?
Exactly. It's for settling trades between institutions, that kind of thing.
So why is that specific use case exempt from the limits?
Well, the official reasoning is that wholesale markets already have their own set of robust systemic limits and controls in place. So they argue these retail-style holding caps just aren't needed for institutional activity.
Right. So the bank is clearly happy for regulated stablecoins to be used when it makes capital markets more efficient, where the main users are banks and institutions.
It certainly seems that way.
But this just lays bare the contradiction, doesn't it? When banks use stablecoins for slicker, faster wholesale settlement, great, no problem, no caps needed, drive on.
But when ordinary people, or even small businesses, want to hold and use that exact same fully regulated, fully backed digital sterling for retail payments or savings,
Suddenly it's too risky. Suddenly it threatens financial stability. Come on.
it absolutely creates a two-tier system. It looks very much like the limits are primarily there to shield the retail deposit base of the big banks, give them breathing room to adjust their funding models.
While simultaneously allowing the efficiency gains for the institutional players in the wholesale markets.
That's certainly a very plausible interpretation of the overall package. It protects the bank's funding from retail flight, but lets them benefit from the tech on the wholesale side.
So for all the banking and compliance professionals listening to this, what's the key deadline? What's the call to action here?
This is really important. This consultation is probably the industry's last big shot to change the bank's direction on this before they finalize the codes of practice later in 2026. The deadline for submitting feedback is 10 February 2026.
February 10th, 2026.
Yes, so firms really need to be vocal now. Make clear arguments about the 20K cap, challenge the assumptions in that stress modeling, and hammer home the competitive damage these restrictions could cause. And don't forget the tax issue.
Absolutely.
Look, the fundamental tension here between wanting stability and needing innovation, it's just not resolved by this paper. It leaves you wondering if the UK system, whether it's BOE rules or HMRC tax treatment, proves too rigid, too slow. Will we see capital markets just find ways to bypass the banks entirely? Or will the UK just quietly wave goodbye to any ambition of leading in digital money and concede that ground to the US and the EU? That's a big strategic question we really need to check.
A crucial question indeed. That's all from us this week. Thanks for joining us for this deep dive.
Thanks for listening to Reg Talk UK.
Until next time, stay sharp and stay compliant.